try to get the tenants comfortable. And then we just try to start cleaning it up and really educating these people on, look, you got $3,000 a month. I get you at $5,000 in bills, but if you don't pay our $900, you don't have a home. And then, that's how we handle it kind of from a management level. And then our asset team who oversees management, whether it's third party or not, we have a certain cadence, from every day to once a week to biweekly to monthly on how much we touch an asset based on where it's at in the stabilization process.
Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appelman, founder and CEO of Appelman Properties. Today we're joined with Brian Ferguson, founder and managing partner of Fergmar, with 356 million in transactions plus 1,000 multifamily units. Cycle-tested operator focused on capital preservation, strong returns, and generational wealth. Brian, we appreciate you coming on the show today. If you could, let the listeners know a little bit more about yourself.
Yeah, appreciate you having me, man. Yeah, so I've been real estate 20 years, got it in 2005, started out in single family, then multifamily, came kind of through that recession piece there, learned a lot. We did that for years, shifted to built up a portfolio and a team. And then I started doing some passive investing. And then back in 22, started taking on some capital partners. And we're currently going after acquiring larger multifamily and shopping centers in Texas.
So I was reading through some of your bio, and it stated that you used a lot of your own capital or all of your own capital to build up your portfolio. Is that correct?
Yeah, from 2005 to 22, we did not take in any outside capital at all.
So that's the biggest part to me, because that's the most interesting. Because once you decide to cross over to taking outside capital, it's a totally different ballgame, and you go into private equity more than anything. But tell us about your journey when you started, and then how far you got to build your own portfolio without outside capital.
Yeah, so started 2005, just kind of buying a single house and then doing fix and flip. We built that up over the years, doing between 100 to 200 transactions in single family, wholesale, and fix and flip. And then we started buying apartments like 2008, 2009, kind of buying, distressed, really good deals. But we had to pass up on a lot of them too, right? We were constrained by our capital, never wanted to bring in any partnerships. Then over the time, we built up about 150 single family portfolio. Then at a certain point, we started selling that off, and then we would 1031 in tranches and buy multifamily. And that went on till about 18, 19. And it just got to where there wasn't really, one, we weren't seeing deals in multifamily at all. And two, when we were selling stuff, you have a couple $100,000, it wasn't enough to buy anything of scale. So I started kind of passively placing that money throughout COVID years. And then come back in 22, originally just partnered with some guys and we started buying a couple shopping centers. That was the purpose of it. And I thought, well, this will just be the new thing. Multifamily is not really priced well. And then I guess we're buying a little bit of apartments, and I guess in maybe 23, really going into 24, I started just seeing all the resemblances of that 08, 09 era we had lived through. And I started really remembering, sitting there one day thinking, I drove by a complex that we missed out on that was like, I don't know, 1.5, probably worth 8.5 now. And I just remember I missed out on that. And I'm like, that's fixing to happen again unless I go sell. So I was like, well, I'll just go sell off a bunch of, at this point we have about 90 million in assets under management, non-syndicated. We're like, okay, well, let's just go pull a bunch. There's probably 20, 30 million in equity there at least. Let's go pull a bunch of that out and just, dry powder, be ready for it. But then what wasn't a good time to sell? Refi rates weren't great. And we were already kind of organically, people were referring, their brother or, a buddy. And so we'd start taking a little bit more capital. And my attorney had already said, hey, look, like this is full syndication. You really need to structure it more. So in 24, we decided we'll fully build out this capital company and start building this, investor base to be prepared for what, fast forward, exactly what we saw in 25, buying very deep discounted multifamily. And so that's our focus. And as long as that run lasts, which we think will be a few years. But that was the reason for the transition, is just to be able to really take advantage of the opportunities that's coming in this market. This cycle.
Yeah, where are you seeing the opportunities? Are they bank owned? Or are they operators? Because you'd still have to negotiate a short sale because there's such a high basis right now. But where are you seeing that?
So I think those will come, and we've seen some of that where they're underwater. It doesn't make sense. Like for instance, the one we bought earlier in the year, this was a 19 purchase, but they put a bunch of equity into it. So maybe their purchase price was underwater, but their loan balance wasn't. And we were able to assume, their agency debt, like a 4% agency debt. So it worked out well. The one we're buying now, again, they're what they're in it at is, but Now they're losing 8 million in capital. So the bank balance is a really great deal. What they're in, it's not, but they put a decent amount of money, did all the CapEx out of pocket. So I think it just depends on the deal. We've underwrote some to where the balance is millions higher than we would even offer at. So, but all of ours so far have been, we're going directly. I took a piece. So I have an acquisitions team that I've had for years. We took a piece of that acquisitions team over, throughout 24 to 25, and we built out a department. All they're doing is just hyper focused on finding distressed deals or expiring loans.
Got it. So in that case, LPs lose they write off their portion, but you all start with a brand new basis and new LLCs, and everything has to go through, of course, the channels, the legal channels, and then take it over there. It's more of a reset on basis play. It might not even need deep value add, deep CapEx, just business plan. As far as
I think there's both out there. The two we've done did need, they definitely needed some just deferred maintenance, because what we've learned is if they're in this trouble just from kind of, call it inexperienced operators, and I don't mean that in a bad way. They can be super bright guys. They're just not experienced in this specific field. And normally due to that, there's going to be some things from call it value add or just, deferred maintenance, what have you. There's a piece of it. The past two have been both, which is great because we can bring the value in on just proper operations and, OpEx budgets, but then we can also maybe raise the rents a little bit. So, and you get to see it on both sides, and you add those two in with a lower basis. That's where the home runs are created.
Very cool. Getting back to your roots, starting out with single family and then getting into multifamily. For the listeners, how did you make the transition? Again, you're using your own capital, so that's important. These are important nuggets for the listeners. Using your own capital, starting small and building up from there. Tell us about that journey.
So we started off single family, and I used to have the mentality like, why would I ever want to, make $50 a month on something when I can make 20,000 and sell it tomorrow? I have the complete opposite mentality of that now. I wish I would have got there a little sooner. We fell into it we couldn't sell them. We were in a bad market. So you'd go buy all these houses at tax sale or foreclosure, and there was tons of them. Maybe you bought it for 10, 20,000 bucks. Well, if you couldn't sell it, but you could get $750, $850 a month. So we started doing that, and that's how we built up this huge portfolio of, I say huge, about 150 of single family. And then along that way, we started treating some duplexes and fourplexes the same way, because for a certain point, we were a we buy house company. We became a we buy and sell real estate company. Land, duplex, I don't care what it was. If it was in Victoria, Texas, commercial, we're in it. And then if we couldn't sell it, we'd rent it out. And then we eventually just educate ourselves and started realizing, no, we actually want to build this rental side. So then we became intentional on doing it. And we were buying, some bank owned, like remember buying, 21 unit complex directly from the bank, $9,000 a door, stuff like that. And we were, intentionally doing it at that point.
Got it. You said you've got around $90 million worth of assets under management currently?
That's pre-syndicated. With our syndicated portfolio, we're approaching about 130 now.
130. So is that you're over 1,000 doors, $100,000 a door basis? Is that right?
Say that one more time.
A little over $100,000 a door basis. Is that where?
Well, that's about 1,000 multi. We're fixing to close on one. It'll put us about 1,300 multifamily units, about 500,000 square foot of retail professional centers, and then we still own some of our old. We don't buy these assets anymore, but mobile home park. We have some self-storage. We have some single tenants. So there's a mix in there.
What systems are you using behind the scenes to manage your portfolio?
So we have a property management leg. So we manage a big portion of our stuff. We do some third party. We use Buildium for the management side. For the investor communication, we use a program called Syndication Pro. Okay. And then as a company, like collaborative wise and all that, Asana is a big piece of our of what we do. And then we have built out a lot of our own, like we built out our own asset tracker where we track kind of when to sell, how to sell, some of that stuff.
Okay. That's good for asset management. We use Appfolio, Slack for company communications. I still personally use Asana. It's good for target tracking on a personal level. What about just any kind of AI forecasting?
So we use, we got a guy on our team that's just really proficient in that stuff. So a lot of we're building, like for instance, our deal room is an email. We forward deals. They go to our deal room. It automatically gets scrubbed through AI, compares it to our buybacks, creates an Asana task, assigns it to our underwriting, and then kind of what boxes it checks. So we're doing it for some stuff like that. Personally, I use Claude. The new 4.5 Opus has been extremely helpful. So, like I don't ask it to review offering memorandums or PPMs, right? But like I've fed it enough to where it knows what I'm looking for, gives me bullet points, and kind of just helps speed it up. I use it to my email responses happen through there. I just prompt it what it needs to happen. It's still me doing it, but then it goes and does things in Asana for me. So we're using it at different levels. On the underwriting piece, we're using it for a lot of that, but we still have a lot of manual, oversight on that as well.
Yeah, there's nothing can replace the manual Excel underwriter. Just play with the numbers and see where you can push things. Yeah. I started using Notebook LM, and it's cool because you could drop in the OM, the rent roll, the T12, T3, plot surveys, environmental, all the things. And its source of truth goes back to everything you've uploaded. So it's not going out to try to find information every time. It's using what you've uploaded to scour through and find the information from the source of truth. So that's been very cool and kind of not game changing, but just keeping everything, all the information kind of organized under one roof.
I would agree that a project, I use the Claude projects the same way. So when we have a property, I put Claude and then I put everything in there. And like I just had an investor email me earlier and he was like, hey, previous ownership's CapEx, it was 3.5 million. What did they spend it on? And I'm like, okay, I'm gonna have to go. I know I kind of know the answer, but I need to go find it. Well, I just asked it and it spit it out in 2 seconds because we talked about it a couple months ago.
Yeah, I think AI will enable everyone to do a lot more. I'm not seeing what I know for certain, and I wasn't sure at the beginning, I don't see it taking, it's going to take jobs away. There are certain jobs, but it's not going to take away people that are, I want to say just resident experts in their niche. Yeah. If you've got the knowledge, you can speak fluently, you know what the prompt needs to be. Those people cannot be replaced by AI. Because ultimately, the other people are asking the experts still what to do. Because AI is going to get you so far. It's going to tell you exactly what to do next, but you still have to do the next thing and know what comes after there. One of our project managers is you still have to have somebody who can get the capital, go out there, get the equity, get the capital, still know how to close, still have a track record, still have a balance sheet. Like real estate is such a protected field in general, just because of the amount of knowledge, expertise, and experience that you need to even make one transaction happen.
Yeah, no, I agree 100%. I mean, they're a tool and a resource to assist us, not replace.
Yeah, totally. And then putting AI on say the operator front, even project managing, tracking CapEx. I mean, it enables us to ingest more projects, underwrite faster, and do more things. When you are underwriting these large properties, you're getting ready to do. They're distressed. They need a ton of CapEx. You're implementing new management. What's your plan to bring in new units and then bring them into your ecosystem and manage them efficiently and add the value?
So, I mean, we few pieces to that. One, like like I said, we have a management company, but then we also started doing some third-party partnerships. Because what we determined is even at 1,000 doors, there's some efficiencies that a 30,000 door management company. So if you find not the 100,000 door company where you're not important, maybe the 20,000, 30 door management company. So what we do is, we look at on-site staff. Sometimes we keep, sometimes we interview. It just depends. That's very case by case. But our first thing we do when we bring it in is, before we'll go fix any of the major issues, like downed ACs or dishwasher. Things aren't working, but we don't start swinging hammers and doing major construction for about 30 days. That's very intentional. We just try to get the tenants comfortable, and then we just try to start cleaning it up and really educating these people on, look, you got $3,000 a month. I get you at $5,000 in bills, but if you don't pay our $900, you don't have a home. And then, that's how we handle it kind of from a management level. And then our asset team who oversees management, whether it's third party or not, we have a certain cadence, from every day to once a week to biweekly to monthly on how much we touch an asset based on where it's at in the stabilization process. I'm not sure if I answered the question, but.
Yeah, it's bringing it into your ecosystem. What systems are already in place? You've answered that, and then really it's managing from there. Because that's where I see a lot of operators, not you, but like you had mentioned before, inexperienced operators get tripped up at it. Is now it's closed, and really now the work begins. But that's where that's where all the question marks start to fly off. Is now what do we do next? We rely on third party. Well, no, because third parties kind of they're already doing their thing. They're working as if nothing's changed. But if you're coming in as an operator and asset managing kind of a piece of the third party, now that's where the performance kicks in and the asset starts to drive the value. It's having that experience, having the other part. A lot of these property managements don't have an asset management arm.
Yeah.
They just manage, and they're hiring the same people that anyone else would hire based off of a resume. So it's important to have that arm that kind of complements not their management, but complements the assets where you can push it.
Well, yeah, I mean, I think what's important is, like people ask, well, because I see so many people shifting into third party and they go, why would you start partnering with? And I'm like, yeah, but ours is a different setup because we know how to listen daily or weekly based on what the cadence of the calls is, based on where we're at in stabilization and like how the property is performing, right? Bad performance is going to increase our cadence. Like, and our stuff's still local. We're boots on the ground. We can deploy an asset team and, we're part of the hiring and firing for our property. So we can take over, instantly. So I think that's very important because if you're hiring a third party and relying fully on them for all the experience level, that's where it's going to fail because you don't know how to, where are your checks and balances, what KPIs are you tracking, things like that. So that's where it's really important. A lot of these guys, and I think like some of these, they're like, okay, I'm going to close. I got paid a bunch of fees, whatever the case may be, but then they don't know what to do. Oh, occupancy is dropping. Why? Well, like a good example, they go under contract and don't pay attention to the mass delinquency. They just go, oh, it's 90% occupied, physical occupied, but if your economics at 60%, that doesn't mean anything. 90 is a worthless number. That's just a bunch of freeloaders living there in a certain extent. So, I think it just all goes into them. It's just experience. And I know a lot of people, have no experience in it and they go, okay, well, I'll get a good management company. To your point, I like the way you broke that down is that's property management, but are you going to bring on an asset manager as well? Because without that, that's the failure point.
Well, and that's where the performance kicks in because not only do you have the asset doing what it's going to do, but now do you have somebody that's actually doing daily comparables? And really rent pricing should be dynamic because it does fluctuate. It does go up and down. But if you've got systems in place where you've got dynamic rent prices per month, that's another piece of the asset management that is not captured. And then really closing in the gap on economic occupancy versus physical. And then getting those delinquencies just squished down to where it might be painful, but evictions do happen, and you need to make that a priority to be collections. Collections are top priority, especially in Class C. It is tough. It is really, you have to manage it with an iron fist because if you let them get out too far, it's just now it's too big of a mountain for them to even climb. So then it rolls downhill from there. But you have to be flexible. You have to help. You have to be willing to be there to put payment plans in place, but at the same time, you have to know when they're telling us true lies, and these are just buying more time, more excuses. Especially after the holidays, we're in January here, but again, it's working with good tenants, seeing what their track history is with us with payments, and going on from there. When you all are going into a unit for CapEx renovations, what are you all typically doing?
Definitely depends on the asset and what the comps are showing, right? There's certain things like, okay, we're going to put paint, floors, countertops, maybe cabinets if it's needed, lighting, all that. We like to look at the bones, HVAC, windows is a big one. If you can do it, that's harder to do on bigger complexes unless it's really budgeted in. But, we'll look at like granite versus Formica. That's really what the comps do. But then where we do get into we're going to go and kind of just do what we call like a quality check on the current, like we're buying a complex. They've already have what they call their platinum units. And then I've had investors go, well, I see that you're going to go spend money on those. What are you going to do if they've already turned them? Yes, they've turned them and they're achieving market rates, but like little things like we put a new faucet on, but then we don't change the supply lines, or like the little cutoffs that cost $2-3. Those are the things that are in calls issues. Now I have to send a technician out. And that's, two pieces, tenant quality of life, because I think one of the biggest hidden revenue streams is retention.
Yeah.
And that doesn't get focused on enough at all. It's just like, and where do you put that in a spreadsheet? But that is a huge piece of it because when they move out, I don't care if it's the best tenant ever, you still have a make ready cost and you still have a downtime. So we really focus on all that. And then we look at, obviously like roofs, HVACs, electrical panels is a massive one for us. So we're looking at all that like from an exterior aspect. And then we try to really manage the amenities aspect of like, we're going to add a dog park. We're going to gate the complex. you don't want to overdo it on the amenities, but I'm not opposed to doing it a little bit above.
Yeah.
It's a little bit of a niche. We're in an interesting market where we're at, one of our current markets, because, there was no supply from like mid 80s until 2014. So B class were never built. So if you want B class property, you create it, get a well-built, well-designed, well-located asset, get good tenants and a good work. So, but that's not necessarily in every market, right? We were going to buy a deal in Kingsville. It cash flowed well, but it was like the property was going to, needed all these things because it hadn't been touched in so long, but there was zero justification to do it because you couldn't push the rents. So it's just you're asking yourself, do I want to buy it cash flow knowing it's going to be a make-ready maintenance and repair nightmare because you can't justify spending the money on it. So, but I think it's very specific to it, but we definitely try to get into the behind the walls and underneath the sinks a little bit, the things that are going to cause tenants problems moving on.
Yeah, and that's operator mentality. It's seeing behind the walls, knowing what the next issue could possibly be, and that saves so much money on the next deal and the next deal. And that's where a lot of the wisdom's paid for through ignorance tax, not knowing what you don't know.
Yeah.
And we just don't want to pay for it again on the next one. So,
yep.
But that's where wisdom comes in place and experience. Definitely excited to see what the next this year and next year bring too. I feel like there's definitely an opportunity. The economics are right for there to be opportunity for the right guys to come in and pick up the right assets for sure. Brian, if a listener wants to get a hold of you, reach out and get a hold of you to learn more about yourself, your company, possibly invest with you, how can they get a hold of you?
Our website, obviously, fergmarcapital.com. And then I'm on Facebook and then LinkedIn, very active on LinkedIn. So reach out to me there, or they can put a request through at fergmarcapital.com, and happy to touch base with anybody looking to invest or just have some questions or needs advice.
Awesome. Brian, definitely appreciate your time. We'll talk soon, and thank you.
All right, man. Thanks. Have a good one.
All right.